But today, France is making headlines for something very different. Its national debt. It has reached a record 3.4 trillion euros.
Europe didn't collapse with a bang. It is collapsing quietly behind polished speeches, optimistic forecasts, and carefully managed headlines, and Africa sees it more clearly than anyone else. While Europe borrows to maintain the image of stability, Africa is reading the balance sheets, tracking the debt, and watching confidence drain from the system. What Europe calls recovery, Africa recognizes as delay. What Europe calls resilience, Africa sees as pressure building.
Major developing news coming from Europe. The Secretary General of the European Union has announced that the EU has lost access to much of West Africa, specifically Burkina Faso, Mali, and Niger. He warned that this development will cause serious problems for Europe as the region has been a vital source of minerals and raw materials. In recent years, many West African nations have distanced themselves from European influence, forcing the EU to reconsider its strategy toward the region.
This isn't about politics, it's about math. As Europe leans harder on debt to hold itself together, Africa is stepping away, redirecting trade, moving capital, and refusing to carry the risk anymore. And with every shift Africa makes, Europe's silent economic collapse becomes harder to hide. And the question is no longer whether Europe is in trouble, the question is how long it can keep pretending it isn't. For years, Europe projected confidence. Its leaders spoke of resilience, stability, and recovery, even as warning signs multiplied beneath the surface. Debt climbed quietly, growth slowed unevenly, public spending expanded faster than productivity. Yet the image held until Africa began exposing what Europe had worked so hard to conceal. The exposure did not come through speeches or accusations. It came through data, trade behavior, and economic decisions that spoke louder than any declaration. Africa did not challenge Europe directly. It simply stopped pretending that Europe was financially healthy. The first crack appeared in sovereign debt markets, African financial institutions, once passive holders of European bonds, began reducing exposure. Central banks across Africa quietly rebalanced reserves away from heavily indebted European economies. The move was subtle but deliberate. Africa was reading the balance sheets Europe hoped the world would ignore. Rising debt to GDP ratios, aging populations, and shrinking tax bases told a story of long-term strain, not recovery. Europe noticed but dismissed it as diversification. Then came trade recalibration. African exporters, particularly in energy, minerals, and agriculture, began revising contract terms with European buyers. Payment schedules shortened, risk premiums increased, long-term fixed-price agreements were replaced with flexible pricing. Africa was signaling something Europe found uncomfortable. Trust was eroding. Europe had long relied on cheap financing to mask structural weakness. Debt funded welfare systems, subsidies, and industrial support without corresponding productivity gains. Africa recognized this model because it had lived under it before. It knew how debt could create the illusion of prosperity while hollowing out real economic strength. Africa decided not to participate in the illusion anymore. The most revealing shift came in infrastructure finance. European firms, once dominant in African development projects, suddenly found themselves sidelined. Africa chose partners from Asia, the Middle East, and within the continent itself. The reason was simple. European financing came with hidden fragility. High debt levels limited Europe's ability to sustain long-term commitments. Africa wanted reliability, not reputation. Europe's silent collapse became more visible through currency behavior. African trade settlements increasingly bypassed European financial centers. The euro was still used but no longer trusted as a default. Africa preferred diversification, hedging against instability Europe insisted did not exist, but Africa saw the numbers. Public debt in multiple European countries had crossed thresholds historically associated with stagnation. Interest payments consumed growing portions of national budgets. Investment in innovation lagged behind social spending obligations. Demographics worsened the picture. Fewer workers supported more retirees, creating pressure that debt could not solve. Africa had learned that debt is not dangerous because it exists, but because it grows faster than capacity. Europe was failing that test. The exposure deepened when Africa restructured its own development financing. Instead of borrowing from European institutions, African nations began issuing regional bonds backed by commodities, infrastructure revenue, and cross-border trade flows. These instruments attracted global investors seeking real value rather than political assurances. The contrast was stark. Africa's debt was tied to assets. Europe's debt was tied to promises. That distinction mattered. European officials continued speaking of stability, but African policymakers listened to markets instead of speeches. Capital flows told a different story. Investors demanded higher yields from Europe. Credit risk assessments quietly worsened. Rating agencies hesitated to downgrade publicly, but internal. Models shifted. Africa noticed. Another exposure point was energy. Europe's energy transition relied heavily on debt-financed subsidies. Africa observed that these programs produced short-term relief but long-term fiscal stress. Meanwhile, Africa pursued energy expansion through partnerships, resource-backed investments, and decentralized systems that reduced budget strain. Europe's approach postponed costs. Africa's approach distributed them. When energy prices fluctuated, Europe absorbed shocks through borrowing. Africa adjusted through diversification. Over time, one model accumulated debt, the other built resilience. Africa did controller this comparison publicly. It let outcomes speak. European companies operating in Africa began facing stricter terms. Africa demanded upfront payments, stronger guarantees, and local reinvestment. Europe complied reluctantly, aware that its bargaining power had weakened. Debt had reduced leverage. The silent collapse was also cultural. Europe's confidence rested on legacy. Africa's strategy rested on momentum. While Europe debated how to protect existing systems, Africa focused on building new ones: manufacturing zones, logistics corridors, digital finance networks, and resource processing hubs expanded across the continent. Africa was preparing for growth. Europe was managing decline. The exposure reached a turning point when African investors began acquiring distressed European assets. Ports, energy utilities, logistics terminals, and real estate changed hands quietly. Africa was not acting out of dominance but opportunity. Europe's debt pressures created openings. Africa was prepared to exploit. This reversal stunned European observers. For centuries, capital flowed one way. Now Africa was buying into Europe not because Europe was strong, but because it was weakened by debt. Africa did not celebrate this shift. It studied it. The lesson was clear. Debt does not announce collapse. It conceals it. Systems fail slowly, then suddenly, Africa had experienced both phases. It recognized Europe was transitioning from the first to the second, yet Europe continued presenting unity. Africa saw fragmentation instead. Wealthier European states strained under transfer obligations. Less competitive economies depended on external support. Political cohesion weakened under fiscal stress. Every budget negotiation revealed deeper fault lines. Africa had seen this movie before. The exposure was not an attack. It was a mirror. Africa's actions forced Europe to confront a reality it preferred to delay. Debt-fueled stability had limits. Social promises required productive foundations. Economic influence depended on fiscal health. As Africa repositioned itself globally, it stopped validating Europe's narrative of strength. That withdrawal of validation was powerful. Influence faded not because Africa challenged Europe, but because Africa stopped believing in the myth. The silent collapse was not happening tomorrow, it was already underway, and Africa, having learned from its own history, was simply choosing not to be caught beneath it. As Africa continued adjusting its economic behavior, the consequences for Europe became increasingly visible. What Europe once dismissed as minor shifts now revealed themselves as structural signals. Africa was not reacting to Europe's weakness, it was positioning around it, and in doing so, it made Europe's debt crisis impossible. To hide, the first major impact emerged in investment confidence. African sovereign funds, pension systems, and private investors began treating Europe as a risk-adjusted market rather than a safe haven. Long considered a destination for stable returns, Europe now demanded scrutiny. African capital managers applied stress tests Europe was unaccustomed to facing: high public debt, weak growth prospects, and political fragmentation raised red flags. This reclassification mattered. Capital that once flowed automatically into European bonds and infrastructure began diverting toward Africa, Asia, and the Middle East. European governments responded by increasing yields to attract buyers, which only deepened debt servicing burdens. Africa recognized the spiral immediately: borrowing. To service borrowing was never sustainable. The exposure spread through trade finance. African exporters demanded stronger guarantees from European buyers. Letters of credit grew more expensive, payment terms tightened, insurance premiums rose. European firms accustomed to favorable terms found themselves paying the price of weakened credibility. Africa was not punishing Europe. It was pricing risk realistically. Europe's silent collapse became evident in its response. Instead of reforming, Europe leaned harder on monetary support. Interest rates were managed carefully to avoid destabilizing debt markets. Liquidity programs expanded quietly. Africa had seen this before. Temporary relief masquerading as recovery always delayed necessary correction. Another revealing shift occurred in labor markets. Europe's debt burden limited its ability to invest in job creation, infrastructure upgrades stalled, industrial modernization lagged, youth unemployment persisted in several European regions despite public assurances. Africa recognized the pattern clearly: debt constrained growth, which constrained employment, which weakened tax bases, which increased debt, the loop tightened. Africa's exposure strategy also affected currency dynamics. As African trade diversified settlement currencies, reliance on the euro softened. This did not cause immediate collapse, but it reduced demand at the margins. Marginal demand mattered greatly for heavily indebted economies. Small shifts multiplied impact. Europe tried to compensate by promoting the euro as a green finance currency. Africa remained cautious. Sustainability without solvency did not inspire confidence. Africa preferred instruments backed by assets, not narratives. The contrast grew sharper in infrastructure. While Europe postponed upgrades due to fiscal pressure, Africa accelerated construction through blended financing, public-private partnerships, and regional coordination. Ports, railways, power grids, and digital networks expanded rapidly. Investors compared timelines and returns. Africa increasingly won. This inversion unsettled European policymakers. For generations, Europe had positioned itself as Africa's model. Now Africa's growth exposed Europe's stagnation. The exposure was not rhetorical. It was measurable in trade flows, capital allocation, and investment outcomes. Europe's debt crisis also weakened its geopolitical influence. Africa noticed that European diplomacy increasingly relied on moral authority rather than material leverage. Aid budgets shrank, security commitments thinned, trade incentives weakened. Africa understood that influence follows capacity. When budgets tightened, reach contracts, Africa adjusted accordingly. New alliances formed beyond Europe's orbit. Trade corridors shifted. Strategic resources were redirected toward partners offering long-term stability. Europe's voice softened, not by choice, but by constraint. The silent collapse became visible in public finance. European governments faced hard choices between social spending, defense commitments, and debt obligations. None were easily sacrificed. Political tensions intensified. Policy paralysis followed. Africa had lived through similar cycles. Once compromise fails, confidence erodes rapidly. Africa's final exposure came through comparison. Global investors, once skeptical of African markets, began viewing Europe as the slower, riskier play. Growth projections favored Africa, demographics favored Africa, infrastructure momentum favored Africa, debt ratios favored Africa. Europe still possessed wealth and expertise, but its trajectory raised concern. Africa did not celebrate Europe's struggle. It learned from it. The lesson was clear: debt-fueled stability eventually demands payment. When that payment coincides with demographic decline and weak growth, systems strain. Africa recognized Europe's predicament because it had escaped a similar one. By adjusting trade terms, investment strategies, and diplomatic assumptions, Africa removed the buffer Europe relied on to maintain its image of strength. Without that buffer, reality emerged. Europe's collapse was not dramatic. It was quiet, incremental, and systemic, and Africa, having read the signals early, simply stepped aside. Before the weight became unbearable,